Let me start with a number, 89%, and that is how far the stock market fell in the Great Depression. Not 20%, not 40%, 89. And it wasn't just the market going down. Thousands of companies that people believed were safe, established, and solid didn't recover. They went to zero completely and permanently. But here is the part almost nobody talks about. During that exact same period, while the market was in free fall, a completely separate group of assets did something that seemed almost impossible. They went up. Some of them went up a lot. And the investors who understood the difference between those two groups didn't just survive the Depression. They came out the other side, richer than when they went in. That same split is setting up right now, in April 2026. And by the end of this video, you are going to know exactly how to tell the difference and which side your money is currently sitting on. The most dangerous assumption in investing is also the most common one. The assumption is this: when the market falls, everything falls. And when the market recovers, everything recovers. It sounds logical, it feels true, but it is one of the most expensive beliefs you can hold going into a financial crisis, because it is completely wrong. What actually happens in every major crash, and I mean every single one, is a split, a violent, fast, and often irreversible split between two categories of assets. The first category absorbs the capital fleeing the panic and comes out stronger. The second category implodes permanently and never comes back. The difference between those two outcomes is not random. It is not bad luck. It is structure. And once you understand the structure, you cannot unsee it. But before we get into the data, real quick, where are you watching this from? Drop your city or country in the comments right now. I read every single one, and I want to know how this is landing for people in different parts of the world, because what is happening in global markets right now is hitting very differently depending on where you are. So let me show you the mechanism, because there is a mechanism. It is not chaos, it follows a pattern. And that pattern has 4 stages that have repeated across every single major financial crash in the last 100 years. The first stage is cheap money flooding the system. Interest rates get cut, credit becomes easy, everyone can borrow. And when borrowing is cheap, people take risks they normally would not. Asset prices start climbing. Then they climb faster. Then they start detaching from reality entirely. Between 1995 and 2000, the NASDAQ surged over 400%. Before the 2008 crash, U.S. household debt hit 98% of GDP, the highest level ever recorded at that time. In 2020 and 2021, the Federal Reserve pumped over $4 trillion into the system in less than 18 months. The setups look different across each decade. The structure is identical. The second stage is when stories replace math. This is the stage most people are already inside before they realize it. Analysis stops. Narratives take over. In 1999, companies with zero revenue were worth billions because they had .com in their name. In 2006, mortgage bundles built on bad loans were given the highest possible safety rating. In 2021, an algorithm paying 20% annual returns was called safe by serious people. In every case, the story sounded so good that people stopped asking basic questions. That is always the warning sign. The third stage is the crack. It is never a big dramatic announcement. It is always one thing, one data point, one company, one peg. In March 2000, the NASDAQ peaked at 5,048, then lost 78% over the next 2 years. In 2008, Bear Stearns wobbled, and the entire credit market realized how exposed it was. In May 2022, the Terra USD dollar peg broke by a fraction of a percent, and within days, $40 billion was gone. The crack is always small. The explosion that follows is always enormous. The fourth stage is where everything gets decided. Liquidity dries up. Forced selling begins. Leverage unwinds violently. And right here, in the middle of the panic, the two categories of assets start moving in completely opposite directions. Weak assets go to zero. Strong assets absorb the capital pouring out of everything else. This is not theoretical. It is measurably true in every single crisis in the historical record. And the investors who understood this before the crack are the ones who walked out of each crash better than they walked in. Let me back that up with specific numbers because the consistency of this data is genuinely remarkable. During the dot-com crash, over $5 trillion in market value was wiped out. Pets.com, which had a market cap of over $300 million, collapsed within months of going public. Webvan raised $830 million from investors and went bankrupt in under 2 years. eToys, once valued in the billions, hit zero. These were not obscure startups. They were the celebrated darlings of the era. But during those exact same years, U.S. farmland generated positive annual returns every single year. Everyone. Gold was trading around $280 an ounce at the peak of the tech bubble and climbed steadily above $400 by 2005. The money did not disappear. It rotated. Now look at 2008. The S&P 500 fell 37% in a single year. From peak to bottom, it was down over 50%. Lehman Brothers, 158 years old, a firm that had survived the Great Depression, 2 world wars, and every major crisis of the 20th century, filed for bankruptcy in September 2008. Washington Mutual had $307 billion in assets and collapsed overnight in the largest bank failure in American history. Bear Stearns was effectively wiped out. Meanwhile, gold rose approximately 25% during 2008 alone. By 2012, it had nearly doubled from around $825 to over $1,650 per ounce. U.S. Treasury bonds returned 17% during the crisis. Farmland delivered roughly 17% gains over the same period. If you held those assets going into 2008, you did not just survive. You grew. Then 2022. Bitcoin went from $69,000 to below $16,000, a 77% drop. Terra Luna fell from $116 to nearly zero in 72 hours, destroying $40 billion in value. FTX went from a $32 billion valuation to bankruptcy in days. Meanwhile, gold held steady. Silver held steady. Short-term U.S. Treasuries were yielding over 5%, paying real positive returns while speculative assets were being incinerated around them. 3 different decades, 3 different asset classes, same structure, same outcome. The assets that survived those crises do not share a price or a sector. They share a structure. And that structure comes down to 5 specific characteristics. The first is intrinsic value that does not need a story. Gold is the clearest example. It has been used as a store of value for over 5,000 years. Its supply grows at roughly 1.5% per year. No government, no central bank, no algorithm can change that. It does not need a narrative. It does not need investor enthusiasm to maintain its value. In 2025, as global debt surged past record levels, gold rose 70% and crossed $3,400 per ounce. Not because of hype, because of structure. The second characteristic is demand that exists, whether markets are up or down. Farmland produces food. That demand is not investor sentiment. It is biology. It does not disappear in a recession, and it does not disappear in a financial crisis. Over the last 25 years, U.S. farmland has averaged annual returns between 10 and 12%. But more importantly, since 2000, in 26 out of 28 quarters where the S&P 500 was negative, farmland was positive. That is not luck. That is structural non-correlation. The third characteristic is liquidity when everything else freezes. Short-term U.S. Treasury bills are the most liquid financial instruments on Earth. In a crisis, investors do not ask for high returns. They ask for certainty. During the COVID crash in 2020, Treasury yields briefly went negative because demand was so intense that people were literally willing to pay for the guarantee of getting their money back. That is how powerful the flight to safety is when fear peaks. The fourth characteristic is 2 separate sources of demand hitting at the same time. Silver is both a monetary metal, people buy it the same way they buy gold during uncertainty, and a critical industrial metal. Solar panels need it, semiconductors need it, electric vehicles need it. In 2025, those 2 demand streams collided simultaneously. Silver surged 143%, reaching $72 per ounce, the strongest annual performance in its recorded history. When monetary demand and industrial demand fire at the same time, the upside is explosive. The fifth characteristic is long-term asymmetric potential, with a very specific catch. Bitcoin is not a short-term safe haven, and I want to be precise about this because the data is clear. In 2024, Bitcoin's correlation with the NASDAQ reached 0.87. When panic spikes, Bitcoin falls with high-risk tech stocks. That is just what the numbers show. But over longer time horizons, it has never gone to zero. It has survived every crash, every regulatory crackdown, every exchange collapse built around it. From under $10,000 in 2020 to over $126,000 in October 2025, it has delivered returns that no other asset class has matched in modern history. The distinction that matters is this. Gold preserves your wealth during the crash. Bitcoin can rebuild it after. Those are 2 completely different jobs requiring 2 completely different position sizes in your portfolio. Now here is where most financial channels stop. They show you what survives, give you a list, and call it a day. But that is only half the picture. Because to really understand why those assets survive, you need to understand what is on the other side. The assets that did not just fall, but went to zero permanently. We are going to look at the ones that did not survive, and the specific mechanism that destroyed them. Because that same mechanism is running inside certain assets right now. And if you're holding any of them, the time to understand this is before the crack, not after it. Let's go through the clearest examples one by one because each one teaches you something slightly different about how this failure mode actually works. Enron had a market cap of over $60 billion. It was on Fortune's most innovative company list for 6 consecutive years. It had investment-grade credit ratings right up until the collapse. The entire valuation of the company rested on accounting that was fraudulent, but because the numbers looked good and the story was compelling and smart, serious people believed it, and the confidence held. The moment the fraud became public, there was nothing left underneath the price. No real assets, no real cash flow, no real value. The stock went from $90 to under $1 in months. Bankruptcy, zero. The retirement savings of 20,000 employees, gone. WorldCom followed. Over $100 billion in stated assets. One of the largest telecommunications companies on Earth. When $11 billion in accounting fraud was uncovered, the stock collapsed. Bankruptcy, zero, no recovery. At the time, it was the second largest Chapter 11 filing in American history. Then Lehman Brothers in 2008, 158 years in operation, $600 billion on the balance sheet. This was a firm that had survived the Great Depression, both world wars, the 1987 crash, the dot-com collapse, everything the 20th century had thrown at global finance. And yet, when counterparty confidence broke, when other institutions stopped trusting Lehman's collateral, the leverage that had made them look powerful became a weapon pointed directly at themselves. They needed short-term funding every single day to operate. When that funding dried up over a single weekend in September 2008, 158 years of history ended in 72 hours. The weakness was not size. It was complete dependence on the continued confidence of other institutions. Terra Luna in May 2022 is worth explaining in detail because a lot of people still do not fully understand what actually happened and why. Terra's ecosystem had 2 tokens, UST, which was supposed to always be worth exactly $1, and Luna. The way UST maintained its $1 peg was not through actual dollar reserves sitting in a vault somewhere. It was through an algorithm that balanced the supply of both tokens against each other. And the 20% annual yield being offered to people who deposited UST, the yield that made everyone trust the system and pile in, was not being generated by real economic activity. It was being subsidized artificially. When a large seller pushed UST slightly off its peg, the algorithm began minting new Luna tokens to try to rebalance. That created more supply of Luna, which drove the price of Luna down, which made the system mint even more Luna to compensate, which drove the price down further. A feedback loop, a death spiral with no exit. In 72 hours, the supply of Luna exploded from 400 million tokens to 6.5 trillion. The price went from $116 to a fraction of a cent. $40 billion in value erased. The entire system was dependent on confidence in the peg. Once that broke, there was no floor, because there had never been anything real underneath it. FTX in November 2022 followed the same logic in a different form, valued at $32 billion as recently as January 2022, one of the largest crypto exchanges in the world. The CEO was on magazine covers testifying before Congress, seen by many as a responsible voice for the entire industry. Then, a leaked balance sheet revealed that the primary asset on Alameda Research's books, FTX's sister trading company, was FTT, the token that FTX itself had created and issued. When that became public, Binance announced they were liquidating their FTT holdings. A bank run started almost instantly. Billions in withdrawal requests hit the platform within 24 hours. The liquidity was not there to meet them. Bankruptcy filed. FTT dropped from $25 to under $1. Billions in customer assets frozen in proceedings that continued for years. Now look at all 4 of those. Enron, Lehman, Terra Luna, FTX. Completely different industries, different eras, different asset classes. But if you strip them back to their structure, they are identical. Every single one of them shared 3 characteristics. First, the price was maintained entirely by continued belief. Confidence that the numbers were real, the peg would hold, or the counterparties would keep lending. Second, there was either extreme leverage or circular dependency built into the system, meaning that when confidence cracked even slightly, it did not slow down, it accelerated. Third, and this is the most important one, there was nothing independent underneath the price. No food being grown, no physical metal in a vault, no direct claim on real economic output, just belief. When belief disappeared, the price did not fall. It collapsed, instantly, with no recovery. That is the framework you need to apply to your own portfolio right now. Because as of April 2026, the macro environment is not stable. It is structurally unstable in ways that mirror previous pre-crisis periods with uncomfortable precision. U.S. national debt has surpassed $38 trillion, growing at approximately $6 billion per day. And here is the number that should give you pause. Interest payments on that debt are now exceeding the entire U.S. defense budget. That has never happened before in modern American history. The world's largest economy is spending more servicing its debt than it spends on its military. At the same time, central banks, the institutions that manage the world's reserve currencies, are doing something very deliberate. In 2024, they purchased over 1,045 metric tons of gold. That is the third consecutive year of record central bank gold accumulation. China and Japan have reduced their U.S. Treasury holdings by hundreds of billions of dollars since 2022. These are not hedge funds making speculative bets. These are sovereign institutions making long-term reserve allocation decisions. And they are systematically moving away from paper instruments and into physical assets. That is a signal, a real one. And the commodity markets are reflecting it. Gold up 70% in 2025, silver up 143%. Those are not normal market moves. In every previous cycle, price moves of this magnitude in hard assets have preceded periods of significant financial stress by 1 to 3 years. Here is the critical thing I want you to take away. You do not need to predict the exact timing of the next crisis to protect yourself from it. Timing markets is almost impossible, and anyone telling you otherwise is selling you something. What you need to understand is positioning, where your capital sits relative to the split that happens in the final stage of every cycle. Because once that stage begins, once liquidity dries up and panic sets in, repositioning becomes nearly impossible. Markets move too fast. Prices gap down overnight. Certain assets become illiquid instantly. The decision has to be made before the event, not during it, not after it, before. The data supports holding assets with a proven structural basis for survival. Gold is your core defense against currency debasement and systemic risk, outperformed in 2001, 2008, and 2022. With central banks buying at record pace right now. Silver as a leveraged version of that same defense, with the additional tailwind of genuine industrial demand from solar manufacturing, EV production, and semiconductor fabrication. Farmland as a real asset tied directly to food production, with decades of non-correlation to equity markets, and a track record of positive returns in 26 out of 28 quarters, when the S&P 500 was negative. Short-term U.S. Treasury bills, not for returns, but for liquidity, so that when prices collapse and the real buying opportunity arrives, you have dry powder and the ability to act. And selective, appropriately sized exposure to Bitcoin with a clear and honest understanding that it is a long-term asymmetric position, not a short-term defensive one. And alongside that, something harder. You have to look at every position in your portfolio and ask one question honestly. If investor confidence disappeared tomorrow, not fell, not declined, but completely disappeared, what would this asset actually be worth? If the answer is zero or close to it, you are holding something with a structural path to permanent loss. Not necessarily a loss that happens tomorrow, but a loss that becomes almost certain in the one specific scenario that actually matters most, a real systemic financial crisis. The trap most people fall into is thinking they are diversified when they are not. They look at their portfolio, see 5 or 6 different positions, and feel protected. But if 3 of those positions are a high-growth tech stock, a speculative crypto token, and a momentum-driven commodity play, and all 3 depend on the same underlying condition, which is continued investor optimism, then you do not have diversification. You have the same bet made 3 times with different labels on it. Coordinated risk disguised as variety. That is not a hedge. That is an illusion that history has punished in 1929, in 2000, in 2008, and in 2022. There is one more thing, and it is the most urgent point in this entire video. The speed at which these crises unfold has been accelerating in a very measurable way. The dot-com crash took roughly 2 years to play out. The 2008 financial crisis unfolded over 6 to 8 months. Terra Luna went from $116 to near zero in 72 hours. FTX went from a $32 billion valuation to bankruptcy in 3 days. This is not coincidence. It is a function of technology. Instant global communication means panic spreads in seconds. Digital markets mean withdrawals happen at the speed of a button press. Algorithmic trading means selling can cascade automatically with no human decision-making to slow it down. Every crash, the speed increases. Every crash, the window to react shrinks. In 2000, you had months to see what was coming and adjust your position. In 2008, you had weeks. In 2022, for some assets, you had hours. The next time, if the signals currently visible in global debt markets and central bank behavior result in a real systemic event, you may not have time to respond at all once the crack appears. The decision has to be made now, when you can still think clearly, when you still have options, when markets are still letting you execute at normal prices. You are not early to this conversation. You are not late either. You are at the decision point, the exact moment where the signals are visible, the data is available, and you still have time to act deliberately rather than reactively. The pattern has run in 1929, in 2000, in 2008, and in 2022. Each time a different story dominated: railroads, internet stocks, real estate, algorithmic stablecoins. The stories were always different. The structure was always the same. Cheap money built fragile things. Narratives replaced analysis. One thing cracked. Weak assets collapsed. Strong assets absorbed the capital and compounded. 3 years from now, there are going to be two very different groups of investors. The ones who were positioned in assets with a structural basis for survival, who watched the crash, held through it, and came out the other side with their wealth intact and the ability to buy at the bottom when everyone else was in panic. And the ones who held assets propped up entirely by confidence watched that confidence evaporate and realized, too late, that there was nothing underneath. The gap between those two outcomes is not intelligence. It is not market timing genius. It is one thing only: the willingness to look honestly at what you're holding before the event happens, ask the hard questions, and make deliberate decisions while you still have the time and the calm to make them well. If anything in this video made you look at a position differently, tell me in the comments. What is the one holding you are most uncertain about right now? I read every single one. And if you're not subscribed yet, the next video goes deeper into exactly how to size each of these positions based on where you are in life. And you do not want to miss it. The pattern does not wait.